Okay, good afternoon. My name's Ian Coleman. I'm one of the directors at Pia First. We're an analytical company, produce reports in foreign exchange, stock indices, commodities, fixed income, banks, hedge funds, retail investors. In 2015, we were awarded the best independent house for FX research by the STA, which is the Society of Technical Analysts. I used to produce quite a few webinars, educational stuff for FX Street, going back about 5 years now. Took over the ownership of PIA about 2 years ago, and our focus over the last 2 years has basically been to build up the company. We're now back. We're going to be doing weekly webinars every Monday for the guys at FX Street. If you do have any questions, please do post into the chat or try and contact us directly afterwards. This week's webinar is basically the dollar. What's happening with the dollar, where we're expecting the dollar to go. Obviously, the dollar is a major factor behind most of our analytical reports. You look at the 8 FX majors, 6 of those are dominated or linked, at least correlated to the dollar index. So a lot of the time, if we can get the dollar index correct, then we can normally predict where the other currency pairs are going to go. We also obviously use correlation with euro sterling, to which is going to be the stronger pair out of euro dollar and sterling dollar. We use our oil charts sometimes to predict where we think dollar CAD's going to go, etc. And gold's obviously related as well to Aussie dollar. Aussie yen is correlated to the stock indices. So we work on all these correlations to try and define where our currency pairs are going to go. At PIA as well, we believe that there is there's always different ways of analysing charts. We can have predictive analysis, which is basically looking at a chart and saying, right, well, we think this is bullish to X level. We'd look to buy on a dip at X level. Or there is reactive analysis, and that is basically how price action reacts when it gets to a certain level. So we believe that for the best analysis is a combination of the two. So we like to predict where we think the currency pairs are going to go, and then we look to price action to confirm either a reversal or a continuation of price at those levels. We've also got a grey box system that we overlay on our currency charts. This basically highlights support and resistance levels. It doesn't just highlight support and resistance levels, but it also highlights time frames. So we might have a support level or a resistance level, actually, which was quite a good example in euro sterling last week. It was a weekly resistance level. We broke it on a daily basis, but then we closed underneath that resistance level, and that then pushes us lower going into this week. So it is quite a unique grey box system, if you like, and we'll talk briefly about that today. But as I said, we're going to talk mainly about the dollar index. We're then going to look at 6 of the major currency pairs to not only to predict the long-term bias on where we think these currency pairs are going to go, but also to predict and try and get some decent intraday trades and some good risk reward analytical recommendations. So I'm just going to share my screen. Let's move this up here. I've got 3 screens on at the moment. So basically what I'm going to do, I'm going to focus on one screen which you use just to produce some charts, and that's actually a Saxo Trader 2 platform. Underneath that, we've got our main screen with our bespoke support and resistance levels, and then of course on the top left-hand screen now, I've got the chat from here. So let's just share this screen. One thing that we used to do on FX Street again, excuse me, going back quite a few years now, was we used to use something called Timeframe Breakdowns. So we'd basically look at currency pair on a daily basis, and we'll say, right, well, this is what the monthly chart is saying. This is what the daily chart or the weekly chart is saying, daily, 4 hourly, hourly. And we could even break it down further into 15-minute and 10-minute timeframes when we're doing some of the live trading room analysis to try and get decent risk-reward trades. Now, the reason why time frame analysis is so important is because you need to know where support and resistance is in a higher time frame. You also need to know whether or not you believe you're trending or counter trending. Counter trends have a tendency to be a lot more mixed and volatile, and of course, if you're counter trending, then your money management should be slightly different. We all also believe that money management is a major part of trading. I'm sure you've heard that numerous times, but we recommend that you try to trade in at least 2 units, and by that we the unit size is not necessarily important. If you've got a €5,000 account or 5,000 sterling account, you're risking 2% per trade or 1% per trade. If you can break that down, even if you're only trading 50p a point, as long as you're trading in 2 lots, in other words, you can get out of one of your positions at your first point of support or resistance, and then try and bleed your second half unit, if you like, or half full size unit, to at least trying to get the next support and resistance, or the medium term target, or even the long term target sometimes. So money management is very, very important. The reason why we're saying that is because obviously if you're counter trending, that should reflect in your money management. As long as the risk reward is ample, then there's nothing wrong with counter trending. But the size of your trades should also reflect the fact that it is counter trending. It's going to be mixed, it's going to be volatile. You don't want to be putting as much of your personal money, your trading capital, at risk if you're counter trending. So the first chart that we've got up is the dollar index. Now, obviously, a very decent rally in 2014. We didn't stop and reverse at any specific technical level. Okay, this is 150%. It's not fib level. It's not what it is, a fib level, but it's not a dedicated fib level, if you like. It's not 161.8. It's not 127.2. So it doesn't make up any Elliott wave formations. It doesn't make up any symmetrical reversal formations. We like to look at these long-term charts and overlay. So basically put the retracement level on, as well as the extension level from the impulse wave on the upside, and you can see that we've got this area here, 102.10, which is a Fibonacci confluence area. Okay, so we've got 61.8% pullback, we've got 161.8% extension level of this wave from 08-09, and we think that that's going to be the next target. If we're talking long term, and of course, we could be talking about 2020 and beyond. My personal belief is that the dollar could end up here. We're going to have a massive fundamental shift for that sort of aggressive rally. All the stuff that's going on. We're 90% technical analysts. Obviously, we listen to fundamentals. Everybody reads the papers, watches the news, etc. I'm wondering whether or not we could have a very large catalyst with Russia, Syria, etc. Over the coming years. One of my favourite guys that I follow is Martin Armstrong, and he predicted, or he has predicted, that this period that we're moving into now is going to be one of the hardest financial periods in the last 30 years. And again, he hasn't predicted a catalyst, a fundamental reason why this should happen, but he does believe that that there's going to be a seismic shift in one direction or the other. But going back to the charts, so we've had this choppy price action on this weekly chart, sorry, monthly chart, since reaching that high in the early part of 2015. And then if we just break that down, we can see that this weekly chart highlights very erratic price action. Okay, a lot of the time, obviously, everyone was expecting the Fed to hike rates. The economic data out of the US has deteriorated, and with it, that outlook. Three bar formations that we really look to, or I look to predict it. Well, first is to predict indecision, okay, and the other is to predict quite a strong reversal. Indecision is normally an insider army candle, and an insider army candle is basically a candle which is fully engulfed by the previous candle. So this candle here is an insider army. Okay, it's inside the previous candle. The way to trade an insider army is you have to wait for a breakout and close of the dominating candle. So in this case, it was October 2014. Debt was the October 13th, 2014, and then the insider army was the 20th, and this was the trigger candle, which is the 27th. We've got to remember we're looking at a weekly chart here. The other main candlestick formation that we look at is the outside candle, and this isn't an engulfing candle, this is an outside candle. There is a difference between the two, and here we have an outside candle, and basically the candle takes over the whole of the range of the previous candle, different than an engulfing candle. An engulfing candle just has to take out the open and the close of the previous candle. An outside candle has to take out the lot, basically. And then the classic is the Doji. Okay, the Doji isn't as strong as an outside candle, but it does highlight indecision. And again, you want to see a Doji candle basically where you're seeing support and resistance, just in the middle of a trend, or if there's no technical reason for a change of trend, is again more highlighting indecision than potential reversal. And of course, with a Doji candle, you're sometimes better off waiting for the next candle to close, so that you'd have a chance of an evening star formation or a morning star formation, which is obviously a free candle pattern. So the weekly chart, erratic. Some analysts are highlighting this as a descending triangle formation that has a bias to break to the downside. I don't think it is. I think it's a channel, and the reason behind me thinking that it's a channel is the price action within it. Do you remember at the start of the webinar we turned around and said that price action, you want to be looking at impulse and corrective moves. Okay, corrective moves have a tendency to be mixed and volatile. They also have a tendency to be free wave patterns because they're not impulsive. An impulsive pattern is 1, 2, 3, which is the aggressive, 4, and then 5 as far as Elliott wave's concerned. And then we get these choppy free wave corrective patterns. If we look in here, these inside waves are made up of free waves. So we've got 1, 2, 3, 1, 2, 3. And I think this is now 1, 2, and 3. So I think we are going to possibly push down towards this sort of 90 area. And if we just put a full ABCD formation on there, okay, it's actually 90.87 is the base. So that's where we would expect this dollar sell-off to stall and reverse. But intraday, we are seeing a bit of dollar strength. The 4-hour chart just overshot 261.8%, and then we've moved back up. The 1-hour chart again is looking slightly impulsive. However, today, look, going back to this chart, sorry, what I should say is this, we can't expect this move to be in a straight line. Okay, this can actually be counted down in 5 waves. So we'd expect a corrective rally in the dollar before the next sell-off. So if we're expecting a corrective rally in the dollar, then we're expecting some downside momentum in most of the currency pairs, euro dollar, sterling dollar, before we see that bias flip again to the upside. The 1 hour chart, we're just moving up and just stalling near this this previous area of resistance. Now, our bespoke level is at 94.99. Should also mention what other indicators I look to with regards to intraday analysis and longer term analysis, and I do look to DMARC quite a lot. Now, I can't highlight DMARC on these charts. I have actually got DMARC on another chart package if somebody does want to look at it. But DMARC basically dictates that after a wave pattern of 9, then there should be a correction. After a wave pattern of 13, then there should be a reversal. And these, it doesn't mean just counting 9 candles in one direction and then it moves to the downside. Every candle has to close higher than the candle 4 candles before. Now, DMARC is used a lot by professional bank traders, investors, hedge funds, etc. And that's why I like to look at it, because I like to look where the main money flow is happening. So in DMARC at the moment, we've got an 8 count, so we're very close to an exhaustion count on the 4 hour chart. And we've also got our bespoke resistance lining up at 94.99. So what's the high from today? So we've got 94.99 as the high. This is obviously while we've been doing the webinar. So it's hit our resistance level and it's just stalling. So intraday, and this is what we're basically playing. Remember, we're talking about predictive and reactive. When we write our reports first thing in the morning, those are our predictive reports. We're now looking at reactive analysis. So what happens when we hit these support and resistance levels? And I think basically what's going to happen today, that's not a very good trend channel, excuse me, is that we're going to move lower or correct lower towards this sort of area in the dollar index before we break higher again in this corrective pattern. Okay, so then we break higher, we move higher, and then we wait for that that move again to the downside. So it's going to be choppy. We've got to remember, we've got ECB meeting as well on Thursday, which could completely turn the dollar bias on its head. But we could quite easily hit these targets before Thursday and then flip the dollar bias around. So at the moment, the intraday bias in the dollar is bullish, but not at this level. Okay, we would now look to buy dips, and we'd look to buy dips around about 94.54. You can then, obviously reflecting it back onto the dollar majors, then look to pull your stop levels in on a break of 95, the figure on the dollar index, and then you'd want to target, or measured move target would be 96.20. So just to reiterate what we're looking at in the dollar, over the medium term, or the long term I should say, we're looking for dollar bulls, and we're looking for this confluence area, okay, 102.08 to be the main target. Over the next couple of months, we're looking for the dollar losses to deepen, okay, and 90, between sort of 90.87 and 90 the figure being a major area of support. Intraday, so breaking it down again into a shorter time frame, we'd look to buy dips in the dollar for a rally higher. Okay, has anybody got any questions about the dollar index before we then start reflecting these views or these outlooks back onto the major currency pairs? No? Okay. Just going to test that the chat's working. And by the way, these are, again, there's different types of analysis that we've talked about before. There's predictive, there's reactive analysis. And as we said, we like to use a bit of both. There's also two types of two ways of trading with charts. There's a chartist, which shouldn't be mistaken as a technical analyst. Okay, a chartist purely looks at charts and price action, doesn't look at indicators, oscillators, etc. A technical analyst is the opposite. He looks, or is a combination. He also looks at charts, but he looks at indicators and systems, okay, that predict movement. When we do our webinars or our educational offerings, if you like, we prefer to use vanilla charts. So we're basically looking at very little in the way of technical indicators. We want to see price action and basically look at trend lines, support and resistance levels, and then our bespoke support and resistance levels. So euro dollar monthly. Again, we're in a choppy corrective pattern. This price action has been mixed and volatile around the 61.8% pullback level. This can be seen again in choppy wave patterns. So over the long term, I still think that this is corrective, but I think we've still got a scope to move to the downside, and I think parity is going to be very attractive for euro dollar bears eventually. We've got a 161.8% extension level coming in at 10085, and we've also got the 78.6% fib extension level, retracement level from this 2008 move. And we've also got an area here where we quite obviously had some consolidation around this extremely important big figure. The daily chart. Now, again, I've seen quite a few analysts, chartists saying that this is basically a channel formation. So we'll just stick the channel on. And we're going to keep on moving to the upside. I think it's more like an expanding wedge, which is similar to a channel formation, but has more of a bias to break to the downside. In other words, this channel could continue for some time. The expanding wedge, we'd prefer to see the break here to then confirm the break of the wedge, and the first target area is the start of the wedge, which then offers quite decent risk reward, 105 the figure. What we have got here, which we can't ignore, is what we were talking about previously, is the outside bar. Okay, so we've had an outside bar produced after Novotny's comments last week, and we had some follow-through selling on Friday, and we've also had some rallies being sold into today. Now I'm just going to put my other screen so I can highlight my support and resistance levels, and then we're going to break down into shorter time frames. So we posted a report about this on Saxo's trading floor this morning, and this is looking like a head and shoulders formation. So a head and shoulders formation, and again, just messing me about a little bit, is a strong rejection of gains, then a retest, but not of obviously the major sell-off, but a retest to see whether or not that strong sell-off is going to hold. And that's what produces a head and shoulders formation. So basically here is the left shoulder. Here's the head. This is the neckline where we've seen support, and then normally we get a retest. So we were actually looking up around these levels this morning, this 114, the figure. We have broken to the downside. Now, this is where our support and resistance, and also our demark exhaustion levels comes into consideration. So even though it's broken to the downside, the reason why we weren't looking to take a trade to the downside this morning is because, while we prefer to sell into rallies, I should say, instead of taking the trade to the downside, is because we have bespoke support at 113.22. Now, if you remember, I also discussed the fact that there was time frames on our support and resistance levels. So this time frame actually allows for a daily close. So if that holds, if 113.22 holds by the end of play today, which is some time off yet, but we are forming a doji just underneath that price action at the moment, or that support level, then we would expect a bit more of a move to the upside. So at the moment, we're a bit mixed here. We've got a demarket exhaustion count, which is holding on the 1 hour chart. We've got some daily support coming in at 113.22, and we're forming a doji. So we really need to get a daily close underneath that 113.22 level before we can say that this head and shoulders formation is going to hold. And then we'd look to 111.70 to the downside. If this doesn't hold, in other words, sorry, if this does hold and we start to move back to the upside, then 114.16 is going to be the area where we'd look to get short over the next couple of days. Okay, the bias is still bearish. It's just getting the right entry level. And timing is everything in foreign exchange or any type of trading. We've got that bearish outside daily bar, okay, which is pushed this currency pair to the downside. We also had a 9 count on the 6 hour chart at the high. We then produced outside bars, I think it was in hourly, 2 hourly, 4 hourly, 6 hourly, 6 hour time frame. So, you know, we had to be short in euro dollar, but we've hit some daily support here. The call at the moment would be to sell into rallies or to look for a daily close underneath this very important 113.22 level. So that's euro dollar at the moment, reflecting that dollar bias back onto it. And of course, remember, as we were saying, the long-term focus is bearish. Over the medium term, and when we say medium term, we're sort of talking 2 to 3 weeks here. There's nothing to say that this currency pair can't move higher. We haven't got any of our bespoke resistance levels, really, any significant ones until 116.40. So it all depends on what that sort of dollar index does and where the close is today to reflect back where the bias is going to be over the next 2 weeks. The immediate bias, as I said, the intraday bias is bearish, but only selling into rallies. Cable. Again, the monthly chart, this looks to be a large corrective flag formation. The scope for a move in either direction before we get a significant breakout. But this is corrective. This is impulsive. This is corrective. I know sometimes it's hard to look at yearly charts, but you know, over the long term, the bias should still be for weaker sterling against the dollar. And again, reflecting that back, that means that dollar index forecast for higher dollar levels over the next few years is still quite valid. If we break down into the weekly, and again, it shows how strong these reversal formations are, if you can spot them. And there's an outside buy here at the low, okay, and then we've moved up. What I think we're going to get, I'm just going to drop this off. I'm just going to put a fig retracement level on. Okay, three wave pattern up to the 50% level, but this is not impulsive. Okay, so I think we're going to end up pushing further in cable. And reach, well, probably the 61.8% level, which we'll probably consolidate at for some time. Because if we look around here, this was quite a significant area of support and resistance. If we look back through the chart, okay, this again, this is support, this is resistance, resistance, resistance. So this area here is going to be a significant barrier for sterling dollar, and a break there, and I'd only expect another rally up towards sort of 164.50 area before dollar bulls come back in. And remember, intraday bias in the dollar is mildly bullish buying dips, but the long-term bias in the dollar, once we've had that move towards that daily dollar index channel base around 90, remember, around 90, 50, which gives this scope to move to the upside before it tanks again. So the long-term bias for cable again is to the downside. Medium-term bias is to the upside. Intraday bias, even I think for cable, is probably mildly bullish. And if we're looking here, again, this looks like a corrective channel formation, 1, 2, 3, 4, 5, and then this choppy price action, and then I think we break higher as that dollar strength comes in. Our trade recommendation this morning was to try and buy around the 152.50, sorry, 152.90 area, which we haven't got to. The stop was placed under 152.60, and then looking for last week's highs. So sort of quite a decent risk reward level. The reason that we were sort of not just buying at the open in cable was because of this trend of lower highs. And first thing this morning at 5:30 when I was writing the report, it did look like there was scope for a descending triangle formation. So we'd prefer to buy the dip than to trade the breakout. So again, the bias in sterling dollar, the long-term bias, and again, when we're talking about, we're not talking about weeks here, we're talking about months and years, is to the downside. The daily bias is to buy into dips, and really we've now broken this trend of lower highs. So it'd be nice if we could get in on a retest of the base or the breakout, which is around 154.63, but I don't think we probably will on an intraday bias. And the next target level is obviously this channel top around 157.06. We're talking about correlation. Okay, we've been mainly, or we are mainly talking about the dollar today, but we should briefly mention euro sterling, because euro sterling we're quite decent bears on. So even though we're strongly bullish in sterling dollar, we don't have to be as strongly bullish in euro dollar, because obviously we think euro sterling is going to keep on moving to the downside. And euro sterling looks like it's in a quite a large reverse head and shoulders formation, and it's got ample scope. To get my other charts on, I can tell you where we've got support coming in. I mean, this week support is seen at 72.87. If we break that, then the right shoulder is not seen until 71.20 in euro sterling. And again, we don't recommend selling here because we had an intraday head and shoulders formation, and the target level for that, which was one of our calls last week, we actually posted it, I think, on Thursday morning on Saxo Trading Floor, was 73.10, and that was the head and shoulders target, and that's what we're just hitting at the moment. So again, Euro sterling using correlation, getting off the dollar a bit here, but euro sterling using correlation, our bias is still to the downside, but selling into rallies now, really around 73.70, 73.80 area intraday. Dollar Swiss, the monthly chart tells us nothing really, apart from we're sort of sitting around sort of multi-year lows when you look at the big picture anyway. Dollar Swiss used to be extremely easy to forecast, because all we had to do was forecast euro dollar and then reverse it for dollar Swiss, because they were -1 correlated when the euro Swiss hedge, if you like, was put in place, or the barrier was put in place. Obviously, as soon as that was pulled, and this happened, we all remember the day. We most definitely all remember the day that happened. But the trouble that's left as well, especially on a lot of chart packages, is that because there was so much volatility that day, or even a couple of days afterwards, was that different companies, different spread betting companies, different trading companies, different feeds, bank feeds, whether or not it was retail feeds, had different highs and lows for that day. So it's made long-term analysis, if you like, quite hard. We are in a corrective channel. The intraday bias, or the immediate bias, is harder to predict. Now, if we break down to the daily chart, this is obviously the crazy day that was. We can count this data, because this data is clean, if you like, and we are in a consolidation triangle formation. This formation has an eventual bias to break to the upside, but we could consolidate maybe even till the end of this year. Short term, and again, this was one of the studies that we put onto Saxo trading floor this morning, was that we were expecting a break to the upside, because we had an ascending triangle formation, and we had a mild bullish bias. We are now correcting slightly lower. Let me just get my other charts on the other page. 1 second. Okay, we're actually, it's a difficult, this move, let's just put this one on. This move to the downside stopped at 61.8%, okay, of the last rally. Okay, so this was 61.8% of this last rally. So we've stopped, and then we've moved higher. However, if you look to the daily chart, these are not impulsive moves. Okay, this is virtually a doji day. This is another inside day. They're virtually both inside this bearish day, this bearish candle. So it doesn't produce strong signals, because what we are looking for is we're looking for a strong break to the upside, and this is actually false. Again, this is false data on the open here, because that is actually a channel formation or ascending triangle formation. And what we basically advised our customers this morning to do was to buy the break, but we're also very wary that this might turn into a channel formation. And that is one of the issues that you have with ascending or descending triangle formations. The breakouts don't always reach the measured move. When I mean the measured move, you basically take the low to the swing high, and then the breakout level. And the measured move is sort of 96.25. But because of the channel top, sometimes it doesn't reach there. Two other factors that could quite easily halt dollar Swiss, at least in the short term intraday bias, intraday basis, is we've just hit the top of the daily cloud base, and it was a good break to the downside. DMARC has also just posted a 9 correction count on the 4-hour chart, and that looks like it's going to close with a doji candle. So if we break back down inside of this triangle formation, then that upper bias it has disappeared basically, and this then becomes a corrective channel formation, and then the bias gets flipped again to the downside. Oh, do I expect us to make the channel base? Well, it all depends on what this dollar does over the next few hours, and also highly important is where that euro dollar closes today. Just going back to what our level was, it looks like it's holding for the time being 113.20. So if we can get, if it's trading 28 at the moment, so if we can hold that 13.20, then again that dollar bias gets flipped again to the downside. But it's difficult intraday because we've still got this potential right shoulder. So this is what we need to concentrate on today, or even maybe tomorrow morning. Now, just thinking it's 12 o'clock. Digressing a little bit, sorry. So the immediate bias, like I said, for the dollar is now to the downside towards that head and shoulders right shoulder, and that potentially will be the channel base in dollar Swiss. We then need to see what sort of reaction we get when we get to that right shoulder on an intraday basis. Dollar yen. Hold that 13.20, and again that dollar bias gets flipped again to the downside. But sorry, I just flipped onto the chat then. Dollar yen, dollar yen, dollar yen, dollar yen. Monthly, it's bearish, and again, I think this is. I think we're going to get a stock market sell-off. Talking about correlation, I think that's going to push dollar yen to the downside again on sort of safe haven currencies. So basically, sell the dollar, buy safe haven. But I don't think dollar yen is going to be the best currency pair to play, because I still think that euro dollar or the euro will move to the downside. So we're using correlation, you're probably in the long term better off shorting cross currencies, Aussie yen in particular, over the long term than you are dollar yen, because I think dollar yen will still have that safe haven factor in it as well. Is in times of great turmoil, people do still buy the dollar. But the immediate bias is to the downside. We've got a bearish outside candle, monthly candle, 103.70 is support. So 16 big figures off current levels. Again, I think this could be a slightly disjointed head and shoulders pattern. It's not. This was obviously the impulse sell-off that we've had. We've then had some. I think it's something like 38 inside days now. So basically, this candle here, for the last 38 days, we've not broken its range, and it doesn't look like we're going to break it soon, to be perfectly honest. A few people were highlighting this as a descending triangle formation. I think it's a channel. By that I mean, let's get rid of that one. I think it's more likely to consolidate and then possibly break higher to maybe 122.50 before we get the next major move to the downside. Intraday, impossible to predict. I don't know about impossible, but there's no figures out today. There's also something that we put on our report. There's nothing really to drive the market unless there's any sort of news bombs. Probably stay within that range, which is sort of 119.70 to sort of 119.20, 119.10, sorry. And then we'll wait and see what happens tomorrow. This could then be seen as a consolidating channel formation, a flag before it breaks to the upside. But again, price action inside of RAM is, you know, probably 8 hours of inside bars here. If it didn't break to the downside, it then tried to move higher. It's a bit like the daily chart, to be perfectly honest, which has been extremely hard and extremely difficult to predict spikes in both directions for about the last 35, 40 days. So until we really get decent price action, I'd have a tendency not really to want to get too involved in dollar yen. The immediate bias is bullish. We've had a doji day. This could be seen as a morning star formation, but then again, you know, you're only really going to be wanting to sort of on an intraday basis, sort of targeting this channel top at 120.70 odd at the moment. Aussie dollar. One thing we've got to remember about commodity currencies is that as far as Elliott wave is concerned, they can break far beyond 261.8% and have a tendency to run to 423.6, which is down here. Do I think it will? I don't know. Again, over the very long term, it's possible if there's a continued run for the dollar. At the moment, we broke this trend of higher lows. We then consolidated, slight doji candle. Then we've just moved back in. Similar to euro dollar on a daily chart, it's an expanding wedge formation, which basically means very erratic price action inside the wedge, but has an eventual bias to break to the downside. Your first target level on the break is 69. So one good thing about normal wedge formations, so let's just draw a normal wedge. A normal wedge formation is like that. Okay, so what happens is price action gets wound up and it's like a coiled spring, and longs keep on buying dips, etc., etc., etc. When it breaks, that spring gets uncoiled and you get an impulsive move to the downside, and the target level is the start of the wedge. So you always know where your risk is, because your risk is back inside the formation. Sometimes we get a retest. Okay, so your risk is back inside the formation and your reward is the start of the pattern. So the risk reward is always great. It's always 5 to 1, maybe 6 to 1. On an expanding wedge formation, it is the opposite, because price action can continue and price action can get bigger and bigger and bigger inside the expanding wedge. And when you break to the upside, to the downside, if you look here, you know, the break level is 70, the target level is 69. So you've got to remember this is a daily chart, so that's like 100 ticks. You're probably going to need more than 100 ticks is on a safety stop. So the risk reward is poor on an expanding wedge formation. And price action continues to be erratic inside that. Short-term basis, this looks like a consolidating triangle formation. You cannot trade a consolidating triangle formation until it breaks out, because what can happen, again, just going back, we both have a bullish bias, but it can turn into a corrective channel. So what we thought, or what you think is a consolidating triangle formation, if you just try and buy a small dip here, what can happen is it can move to the upside, or it can break here, move down, and then it becomes bullish. Okay, the bias at the moment on an intraday basis, again, and let's just put our bespoke support and resistance levels up, is mixed, to say the least. We've got bespoke support at 72.44 and 72.34, so basically around the overnight lows. If we break that, then we've got support coming in at 71.60, which again is the channel base. So really, if you were to take Aussie dollar longs, I would only be taking them down here. I wouldn't be taking them up here. And then looking for a break to the upside. The next significant level is 75.05 on the upside, and then a break there and sort of 78.70. But on an intraday basis, again, would only really look to buy into dips on Aussie dollar. Dollar CAD hit a very big level. 161.8% pullback level from the 2001-2007 move. So it's obviously a very big level. We posted, I think, an outside weekly. Let's have a quick look. We posted again one of these outside bars, not engulfing, outside, and then we've continued to the downside. We've seen some support. If you look at the daily chart, we've got the trend of higher lows coming in, bang on Thursday's low. And if we break down into a 4-hour chart, this was also a 261.8% extension. So we're expecting price action in this pair to continue to be mixed and volatile. That 261.8% level may well not hold. Again, we're talking about commodity currencies. The trouble is with the trend line here, we're going to have to look for a daily close below. We've got an insider army day, which again is indecision. So we need to see a break below Thursday's low, break and close, to confirm that the bias is still to the downside. What could well happen, and again talking about wedge formations again, is we could move lower in a descending wedge formation and then break to the upside. But again, you need to see the break to the upside to confirm a move up towards 130.70. So the immediate bias in dollar CAD, again, intraday mildly bearish now. We were trying to buy a break of this high this morning as a possible ascending triangle formation. We obviously haven't broken the high. We're starting to move to the downside. So I'd still look to buy dips, but I'd only look to buy dips now, probably around 128 the figure. And let's just have a look. If I just put on our bespoke levels again. Get the right currency pair, it might help. Yeah, we've got some bespoke support coming in at 127.90, so sort of 128 the figure on an intraday basis, looking for an impulse break to the upside. But again, signals are far from strong. So just to reiterate what we've talked about today, we've obviously talked about price action. We've talked about basic vanilla charts. Okay, so this is just looking at a chartist view. We haven't put any indicators over the top. We've talked about predictive and reactive analytical views, and the fact that we should really have a combination of the two. We've talked about money management, the fact that if you're trading with trend, then your trade side should reflect that. And we've also talked about the fact that support and resistance levels, you've got to be careful with support and resistance levels, because it depends what time frame really you're seeing those support and resistance levels in, which makes our system slightly unique, because until the candle is closed, and this is what we used to always say to some of our clients or the people that used to watch some of our webinars, until the candle is closed, you cannot count the candle. A lot of the times you'll get a breakout it might look like it's going to keep rallying to the upside, and you're dying to press the buy trigger, the buy button. You have to wait for that candle to close, because a lot of the time you get false breakouts. If you're going to look for a bearish outside bar, again, wait for the candles to close. You can see them here. Bearish outside bar, bearish outside bar, bearish outside bar. Okay, there's nothing here really to indicate that this upward move has come to an end yet. There's an insider army here, but an insider army, if you're going to play an inside bar breakout, then you want to be breaking out really maximum 2 candles. You can see here this is sort of 3 to 4 candles before we broke out of the main candle. Just going to look see what the dollar index is doing now. So the dollar index is just starting to move lower off our bespoke resistance levels. Like I said, around 94.50 is intraday support. The immediate bias is to the downside. The short-term bias, or over the next 2 to 3 months, is probably for weaker dollar, and then would look for that to be flipped, and the dollar bias to then go strongly bullish. I think that's our time. We've been on just short of an hour. Has anybody got any questions? No? Okay. It's been great talking to you, even though I haven't seen any of the questions. I hope I'm on the right spot for that. Wish all your best with the trading this week. If you do want any more information, obviously come and have a look at our website, or you can get tomorrow reports on Saxo. If not, have a great week, and we'll speak to you again next week. I'm just having a look. I'm just being redirected here. See if there's any questions on the chat. Right, let's have a look. Turner rate rise this year. Hi, see Ishimoku is the preferred indicator. And Lucas, the reason that we look at Ishimoku Cloud is because, like our analytical grey box system, it's forward forecasting. Okay, it shows you where support and resistance is going to be in the future, not where it has been in the past. Okay, that's why we like trend lines. Ishimoku Cloud. It's just another tool that we use. It's not our preferred indicator. Our preferred indicator is our bespoke system. I haven't, unfortunately, got time to go through sterling versus Aussie and New Zealand at the moment. Our daily close time is 9 p.m. Okay, guys. Thanks very much for watching. I hope you enjoyed it. And I'll see you all next week. Okay, thanks very much. Bye.